Most real estate investors spend their time analyzing properties, rents, interest rates, and cash flow. But the most powerful and most overlooked indicator of future real estate returns is state-level GDP growth. Understanding which states are growing, which are slowing, and what industries are driving that growth can literally show you where future rental demand, appreciation, and investment opportunities will develop years before the headlines catch on. Today, we're breaking down the impact of GDP growth by state and what this means for real estate investors. We'll look at the latest data, the fastest and slowest growing states, the industries driving expansion, how personal income trends tie into rent growth, and how you can use these statistics to invest smarter. Everything you're about to hear is based on real data, not guesswork, including the brand new 2025 second quarter GDP report. According to the report, real GDP increased in 48 states in Q2 2025, with the national growth rate at 3.8% and state growth ranging from a 7.3% increase in North Dakota to a 1.1% decline in Arkansas. This single data point already tells investors something critical. Real estate opportunities are not evenly distributed across the country, and the gap is widening. Let's start with the basics. GDP growth represents how much economic output a region is producing. Higher GDP growth means more business activity, more hiring, more income, and more people moving in. And when more people move into a state with strong job creation, demand for housing rises. When demand rises, rents go up. When rents go up, property values increase. When values increase, investor returns rise. So real estate investors must pay attention to GDP growth the same way stock investors pay attention to earnings growth. Now let's examine the fastest growing states. According to page 1 of the report, North Dakota leads the nation with 7.3% GDP growth. Behind it are Texas, Kansas, New Mexico, and Wyoming, all showing strong growth in mining, oil, agriculture, and industrial sectors. These are states with business expansion, job creation, and in many cases, population inflows. Investors looking for rental demand should view these states as future opportunity markets. On page 2, we see industry-level drivers. Mining, quarrying, and oil and gas extraction increased in 45 states and was the leading contributor to growth in multiple states including Texas, New Mexico, and Wyoming. This is a major signal for investors. When energy or commodities expand, they create high-paying jobs, which drive housing demand. Rents in energy-heavy metros tend to spike when these industries boom. Historically, we've seen this in Midland, Odessa, Williston, and parts of Oklahoma. Agriculture also played a key role. The report shows agriculture increased in 27 states and contributed heavily to Kansas's growth. But it also dragged down GDP in Arkansas and Mississippi, two states where real GDP declined. For real estate investors, this means not all growth is equal. Some industries create long-term sustained income. Others create volatile cycles. Now let's talk about the states that contracted. Arkansas saw a 1.1% decline in GDP. Mississippi also posted negative earnings in key sectors. Weak or shrinking GDP is a red flag for investors. It doesn't necessarily mean you shouldn't invest there, but if you do, your strategy must change. Focus on yield, not appreciation. Focus on recession-resistant neighborhoods. Focus on cash flow, not speculative value growth. Turning to personal income, page 3 shows personal income increased in all 50 states, with a national rate of 5.5%. Kansas led again with a 10.4% increase, while Arkansas saw only a 0.9% increase. Earnings grew in most states except Arkansas and Mississippi. Why does this matter? Because rising personal income directly supports rent growth. If incomes rise faster than rents, affordability improves, and landlords can justify moderate rent increases. But in slow-growth states with weak income gains, rent increases become harder because the market cannot support them. Let's connect GDP growth to real-life rental performance. High GDP plus rising incomes equals higher rent growth, lower vacancies, more renters with stable jobs, and higher property values. Low GDP plus sluggish incomes equals flat rents, higher vacancies, and slower appreciation. Investors who enter high-growth states early often experience compound returns as population, wages, and rents push property prices upward. On page 4, we see personal consumption expenditure growth across states. Florida leads with 7% growth. Mississippi sits at the bottom with 4.3%. Consumption growth means spending power, and when consumers spend more, local businesses expand, jobs grow, and real estate follows. This is why Florida, Texas, and the Carolinas have seen explosive real estate demand. Strong GDP, strong consumption, strong income growth. Now let's dive deeper into how investors can use this data to make money. Step 1 is market selection. You should invest where GDP is rising consistently, where industry growth supports future job creation, and where the economic base is diversifying, not shrinking. Look at North Dakota, Texas, New Mexico, Florida, and Utah. These states have strong GDP, strong income growth, and strong consumer spending. These factors drive population inflows, household formation, and housing shortages, all bullish for investors. Step 2 is understanding which industries drive growth. The report highlights that finance, insurance, information, and non-durable goods manufacturing contributed most to national GDP growth. These industries exist heavily in states like New York, Massachusetts, California, North Carolina, and Georgia. Real estate near innovation hubs, financial centers, and tech corridors tends to appreciate faster because wages are higher and job competition is tight. Step 3 is understanding risk. GDP decline or slow growth means you must be more conservative. That doesn't mean avoid, it means adjust. In slow growth states, your strategy is cash flow, lower acquisition prices, higher cap rates, stronger tenant screening, and risk buffers. In high growth states, your strategy is appreciation and rent growth. Buy early, renovate intelligently, and hold long term. Now let's talk about population migration. While GDP is an economic indicator, migration is the human indicator. People are leaving slow growth states and moving to high growth, business-friendly states. This is why Texas, Florida, North Carolina, Tennessee, and Arizona have seen record real estate booms. When GDP rises, businesses expand, people move in, demand for housing spikes, and rents follow. This cycle compounds. But the reverse is also true. Declining GDP can cause population outflow. This leads to higher vacancies, rent pressure, and stagnant values. It doesn't matter how good your property is if the economic engine behind it is slowing down. Now let's blend this with rental categories. In high-growth states, Class A and B rentals do exceptionally well. Young professionals, high-wage earners, and new residents fill these units quickly. In slow-growth states, Class C rentals often outperform due to affordability demand. Investors must match their strategy to the state's GDP reality. Next, let's examine appreciation potential. Real estate appreciation is deeply tied to local GDP. Historically, states with the strongest GDP growth deliver the strongest appreciation over a 10-year period. Slow growth states deliver weaker appreciation but stronger cash flow. Investors who ignore GDP growth often end up holding properties in stagnant markets where rents barely rise. Now let's discuss risk from industry concentration. GDP driven by a single volatile industry, like oil, can be dangerous. Booms and busts cause rent spikes and crashes. Balanced economies create stable long-term rental markets. So investors must identify whether GDP growth is broad-based or concentrated. Finally, here's how to use GDP data to build a long-term investing strategy. Step 1. Invest heavily in states with long-term GDP growth in diversified sectors. Step 2. Monitor personal income growth because that dictates rent ceilings. Step 3. Track consumer spending growth because it signals future construction and business expansion. Step 4. Avoid or limit exposure to states showing multi-year GDP stagnation unless cash flow margins are exceptionally strong. In closing, GDP growth by state is one of the most powerful tools a real estate investor can use. It tells you where the future demand will be. It tells you where rent growth will happen. It tells you where property values will rise. It tells you where to put your money before the crowd shows up. Follow the Finance Shark for more real estate investing analysis backed by real data, real economics, and real strategy.